Hello and welcome. This presentation is brought to you by the experts at Pro Tax Accountant. Now, if you've recently sold an asset and you're now staring down a pretty scary capital gains tax bill, well, you are in exactly the right place. So, over the next few minutes, we're going to explore a really powerful government-backed tool. It's called the Enterprise Investment Scheme, or EIS for short, and it could do more than just manage your tax situation. It could completely transform it. Okay, let's get into it. So let's just cut straight to the chase. Did you just sell a property, some shares, maybe even your business, and now you're looking at a huge capital gains tax bill, wondering what to do? If that's you, you're going to want to stick around. To put some real numbers on this for the 2025/26 tax year, let's say you're a higher rate taxpayer and you made a £100,000 gain on a residential property. You could be looking at a tax bill of £28,000. I mean, that's a huge chunk of money that could be working for you, not just handed over to the taxman. But the good news is, there's a really smart way to handle that. And look, this isn't some shady loophole. It's actually a well-established government program. It's designed to be a win-win for both investors like you and for the whole UK economy. So, the solution we're talking about is the Enterprise Investment Scheme, EIS. It's this really clever initiative that does two things at once. It helps you deal with your tax bill while also funneling investment into some of the UK's most innovative growing companies. So, what exactly is it? Well, simply put, EIS is a UK government scheme that's been around since 1994. It's designed to encourage people to invest in smaller, yes, higher risk companies, the real engines of our economy, by offering some seriously generous tax breaks in return. Now, when it comes to tackling that big capital gains tax bill, EIS has what I like to call its two superpowers. And these benefits can totally change how you think about tax planning after you've made a big sale. So here they are, deferral relief and disposal relief. You can think of deferral as hitting the snooze button on your tax bill, just kicking it down the road for a bit. But disposal relief? Oh, that's even better. That's the one that can make the profit on your new EIS investment completely tax-free. Okay, let's start with superpower number 1, deferral relief. This is all about giving you control over when you pay your tax, which, as you can imagine, is a massive advantage for your cash flow and for planning your future. Let's see how this works in the real world. Meet Sarah. She's a freelancer in London, and she sells a buy-to-let property, making a taxable gain of £100,000. Now, normally, she's on the hook for a £28,000 tax bill. But instead of writing a big check to HMRC, she reinvests that £100,000 gain into a new tech startup that qualifies for EIS. And just like that, her £28,000 tax bill is deferred. It hasn't vanished, mind you, but it's paused. She won't have to pay it until she eventually sells those new EIS shares way down the line. And here's a little pro tip that makes this whole thing incredibly practical. You have a really flexible 4-year window to make this happen. You can make your EIS investment up to 1 year before you even make your gain, or up to 3 years after. This gives you tons of time to find the perfect investment without being rushed. And get this, here's a really crucial point. There is no upper limit on the amount of capital gain you can defer using EIS. Seriously, whether your gain is £50,000 or £5 million, you can potentially defer the entire tax bill. Now, as powerful as that is, stay with me, because the second superpower is where the real wealth-building magic happens. All right, on to superpower number 2. Disposal relief. Now, this isn't just about delaying tax. This is about wiping it out completely on your new investment. This is the part that gets most investors really, really excited. So here's the golden rule. If you hold onto your EIS shares for at least 3 years, any, and I mean any, profit you make when you sell them is completely 100% exempt from capital gains tax. No tax on the growth, 0. Let's jump back to Sarah's story. Remember, she invested her £100,000 gain. A few years go by, the tech startup does amazingly well, and her shares are now worth £200,000. Now, if she had put that money into a standard investment, she'd owe capital gains tax on her $100,000 profit. At 20%, that's a $20,000 bill. But because it was an EIS investment and she held it for over 3 years, her tax bill on that growth is absolutely nothing. She gets to keep the full $200,000. But that's not all. As if the capital gains benefits weren't enough, EIS comes loaded with other fantastic perks. You get 30% of what you invest back as a reduction on your income tax bill. So a £100,000 investment gets you an instant £30,000 off your income tax. And on top of that, after just 2 years, the shares can become completely exempt from inheritance tax, which makes it a brilliant tool for estate planning. Okay, this all sounds pretty amazing, and honestly, it is. But these generous tax reliefs exist for a reason. You're investing in smaller, higher-risk companies. So it is absolutely vital that you understand the rules you have to play by to make sure you get these benefits. If there is one number, just one, that you remember from this entire discussion, let it be this one: 3. 3 years. You must hold your EIS shares for a minimum of 3 years. If you sell even 1 day early, you risk HMRC clawing back all those valuable tax breaks. And there are a few other key conditions to keep in mind. To get that tax-free growth, you have to have claimed the upfront income tax relief. You also can't be connected to the company, which usually means you can't be an employee or a director. The company itself has to stay qualified for EIS for the whole 3 years, and your investment has to be for new shares, not just buying them from someone else. And this is the big question, isn't it? Since these are higher risk investments, some of them are not going to work out. So what happens if the company you backed goes under? It's a crucial question, but thankfully the scheme has a really powerful safety net built right in. And that safety net is called loss relief. It's specifically designed to soften the financial blow if your investment doesn't pan out, which makes the whole idea of investing in these companies a lot more manageable. Let's just quickly break down how this works. Say you invest £50,000, and unfortunately the company fails. With a normal investment, you've just lost 50 grand. But with EIS, first, you would have already gotten £15,000 back from that 30% income tax relief, so really you only had $35,000 at risk. Then, you can claim loss relief on that remaining $35,000 against your income. If you're a 40% taxpayer, that's another $14,000 back in your pocket. So your final net loss on that $50,000 investment is just $21,000. That is a remarkable level of protection. Okay, we've covered a lot of ground. We've talked about the superpowers of CGT deferral and exemption, the rules you've got to follow, and that amazing safety net of loss relief. So, let's pull this all together so you can start planning what to do next. So here's your quick cheat sheet. CGT deferral lets you postpone tax on any size of gain. CGT exemption means you pay zero tax on your EIS profits. You get that 30% upfront income tax relief plus loss relief as a crucial safety net. And just remember those key timeframes. Hold for at least 3 years, and you've got that flexible 4-year window to reinvest. Look, the enterprise investment scheme is genuinely one of the most generous tax structures out there for UK investors. But as you've seen, the rules are strict and you have to follow them to the letter. Getting it right from the very beginning is absolutely key. And that's exactly why getting professional advice isn't just a good idea, it's essential. The team at Pro Tax Accountant, they specialize in this stuff and can help you figure out if EIS is the right move for your specific situation. So to find out if EIS is right for you, or really for any other tax questions you have, you should get in touch with them directly. You can reach them on WhatsApp or by phone at 07985689912, or just drop an email to info@protaxaccountant.co.uk. And hey, if you found this breakdown helpful, make sure you subscribe to the Pro Tax Accountant YouTube channel. They're always posting clear, simple guidance to help you make smarter moves with your money. So I'll just leave you with this one question. Now that you know how to strategically deal with this year's tax bill, what are you going to do with all that potential for tax-free growth tomorrow? Thanks so much for watching.